yen surged sharply in the Asian session today after the government downgraded the economic outlook for the first time in 10 months. In the Cabinet Officer's monthly report, the government noted that weak movements have been seen recently, even though the economy is still expected to be on the way to recovery at a moderate pace. In particular, view on exports was changed to weakening from picking up, and the report cited risks of further slowing down of overseas economies and sharp fluctuations in the financial and capital markets. Views on personal consumption, home building, imports and industrial production were also lowered, but the labor market outlook has showed signs of improvement. US dollar, Japanese yen looks set to take on last week's low of 78.33 today and might now be extending the fall from 79.65 towards the 77.66 support zone. Weakness in yen crosses also dragged major currencies down against the dollar, in particular with the Aussie dollar, US dollar extending last week's fall to 1.0350. Ahead of the highly anticipated Jackson Hole Symposium later this week, Chicago Fed Evans continued his push for additional easing. Evans noted at a seminar in Hong Kong that the Fed shouldn't be in a wait-and-see mode and is already past the threshold for additional action. He urged the Fed, take that action now. He emphasized that clear and steady progress towards stronger growth is essential, but he's not seeing that yet. He thought the current policy won't be able to bring down unemployment rate, which he believed could go below 7% before 2015. He, thus, supports an open-ended bond buying program which would only stop after 2 or 3 quarters of steady fall in unemployment rate, or when inflation jumps above 3%. Cleveland Fed Pianalto also said that the current recovery is frustratingly slow, and large-scale asset purchases can be effective. But she also noted that it is possible that future large-scale asset purchase programs will yield somewhat smaller interest rate declines than past programs. And it is conceivable that, at some point, policies designed to promote further declines in rates could interfere with financial stability. Dallas Fed Fisher said he solicited a paper titled Ultra Easy Monetary Policy and the Law of Unintended Consequences from William White, former Bank for International Settlements head economist. A few key points of the paper could be found in the summary at page 5 and 6. Firstly, monetary stimulus operating through traditional channels might now be less effective in stimulating aggregate demand than is commonly asserted, and cumulative effects provide negative feedback mechanisms that also weaken growth over time. Secondly, easy monetary policies threaten the health of financial institutions and the functioning of financial markets. Thirdly, ultra-easy monetary policy would buy time to pursue other policies that could have more desirable outcomes. But there is danger that such policies are wrongly judged as being sufficient, and that the bought time would in fact have been wasted. In Europe, European Central Bank Executive Board member Asmussen, who's also a former German Deputy Finance Minister, assured that the ECB will act within the framework of our mandate regarding the new bond buying program, and the details could be released on the September 6 ECB meeting. But he also noted that under the framework of the new bond buying program, the ECB will only buy bonds with short maturities. Meanwhile, Asmussen also warned of not repeating the mistakes with Italy last summer, when the ECB bought Italian bonds but the time was unfortunately not used for necessary adjustment measures. Separately, German Finance Minister Wolfgang Schäuble and French Finance Minister Pierre Moscovici announced that they have created a joint working group focusing on development of a banking union and promotion of stability in the Eurozone. On the data front, German GfK consumer sentiment, Eurozone M3 money supply and the Swiss UBS consumption indicator will be released in the European session. Meanwhile, S&P Case-Shiller 20 cities house prices and consumer confidence will be released from the US. US dollar, Japanese yen daily outlook. The sharp fall today argues that recovery from 78.33 is finished at 78.84. Intraday bias is cautiously on the downside for 78.33 and the break will target the 77.90 support next. The overall outlook remains unchanged. That is, price actions from 77.66 are either a consolidation pattern that's completed with 3 waves to 79.65, or is a 5-wave triangle pattern. In either case, a recovery attempt should now be limited well below the 79.65 resistance. A break of 77.99 will indicate that a fall from 84.17 is finally resuming for the 75.56 to 84.17 support zone. In the bigger picture, firstly, there is no sign of trend reversal in the pairing yet and the large downtrend from 124.13 is still expected to continue. Nonetheless, consolidation pattern from 75.56 should firstly extend for a while below 85.51 first. In any case, we'd stay bearish as long as the 85.51 resistance holds and expect an eventual downside breakout.